Hey everyone, this is Ronak Ahuja. I welcome you all again. You have invested your hard-earned money in the Indian stock markets and have seen your portfolios grow. But now comes an even bigger question. How much of that gain is truly yours after taxes? We have seen many investors, especially the newer ones, struggle with the taxability around the equity shares. And with the changing tax rates this year, it becomes even more difficult for them to understand. But don't you worry. In this quick guide, we'll cut through the complexities of taxation and help you understand the taxability of profits on sale of equity shares, whether it's done by intraday trading, delivery-based trading, or by way of futures and options. This will in turn help you make smarter financial planning. So without wasting any further time, let's quickly begin. The equity shares in the Indian stock markets are mainly traded in three forms. The first one being the delivery-based trading. In case of the delivery-based trading, the trader or the investor buys shares for more than one day by taking the delivery of such shares into their demat accounts. This means the positions are not squared off within the same day. This type of trading is called delivery-based trading and is one of the most common forms of trading in equity shares in India. The second one being the intraday trading. In case of intraday trading, the trader buys and sells the shares within the same day. That is, the positions are squared off within the same day without taking the delivery into their demat accounts. This type of trading is called the intraday trading. The third one being the futures and options. In case of futures and options, the trader speculates on the price movements by entering into the derivative contracts. That is, the trader speculates on the price movements by entering into contracts without becoming the actual owner of such shares. This type of trading is called trading in equity shares by way of futures and options. Let's try and understand the taxability of equity shares in each of these three forms by discussing them individually. Let's start with the first one, that is delivery-based trading. Delivery-based trading. A delivery-based trading is where the trader or the investor buys shares for more than one day by taking the delivery of such shares into their demat accounts. That is, the positions are not squared off within the same day. Where in case you invest in equity shares and make profits out of it by selling those shares, then such profits are to be treated as income from capital gains. The primary objective here is to invest and make profits by way of capital appreciation or through dividends. For vast majority of individual investors, that is for about 90% of the individual investors, the profits you make out of selling of shares will be typically treated as income from capital gains. However, for only a certain section of people, the income from selling of equity shares will be treated as business income. In a case where you're a professional trader and engaged in regular and very frequent buying and selling of equity shares and with a very substantial amount, and you treat your shares as inventory or stock in trade, then in such a case, your income will be treated as income from business. In simpler terms, if you're a professional trader and your main objective is to trade in shares, only then your income is supposed to be treated as income from business. However, in vast majority cases, almost 90 to 95% cases, your income from selling equity shares will be treated as income from capital gains. Now, these capital gains are further classified into two broader categories. That is, short-term capital gain and the long-term capital gain. Where in case you sell shares after holding it for a period of 12 months or more and you make profits out of it, then such profits will be treated as long-term capital gain. However, If you sell your shares before 12 months, then in such a case, the profits arising therefrom will be treated as short-term capital gain. Now, I'm pretty sure there will be one question on everybody's mind, and that is, why do we need to classify capital gains into further two categories? The answer is to determine the tax rates. Yes, you heard that right. The tax rates in case of short-term capital gain differ from the tax rates for long-term capital gain. And that is the primary reason why we need to classify these capital gains into short-term and long-term. Now, the tax rates that are applicable in case of short-term capital gain are 15% or 20% as per section 111A of the Income Tax Act. In case you sell your shares before the 23rd of July 2024, the tax rate that would be applicable would be 15%. However, if you sell it off from 23rd of July or after 23rd of July 2024, then in such a case, the tax rate would be 20%. In case of long-term capital gains, the tax rate would be 10% or 12.5% of the long-term capital gain as per section 112A. In case you sell your shares before the 23rd of July 2024, the tax rate would be 10% without indexation. And in case you sell it after or on the 23rd of July 2024, the tax rate would be 12.5% on the value without indexation. Now, are there any exemptions available with respect to long-term capital gain or short-term capital gain? The answer is yes. In case of long-term capital gain, no taxes would be charged up to rupees 1,25,000 of the long-term capital gain earned during the financial year. This means there would be an exemption of earnings up to rupees 1,25,000 of the long-term capital gain that has been earned during the financial year. However, there is no such exemption available in respect of short-term capital gains, and hence the difference. Now, let's move on to the profits that have been earned by way of selling of equity shares and which are being treated as the business income. In such cases, the applicable tax rate would be the normal tax slab rates. Yes, you heard that right. There are no special rates of taxes defined in such cases. In case the profits are being earned by way of selling of equity shares and those are being treated as business income, then in such a case, the tax rates that would be applicable would be the normal tax slab rates. Further, there would be no exemption available in such cases. So, this was the tax rates that would be applicable in case of profits from selling of equity shares when they are treated as short-term capital gain, long-term capital gain and business income. Now, moving on to the next segment, that is intraday trading. Intraday trading. And intraday trading is when the trader buys and sells the equity shares within the same day without taking the actual delivery of such shares. This means the positions are squared off within the same day without taking the actual delivery. As per the income tax rules, all the intraday transactions are to be treated as business incomes without any exception. That is, all profits or losses that are earned by way of intraday trading will be treated as business income and not as capital gains. This has been set out outright by the income tax rules. Now, I would further like to highlight there are two types of business income. One is the normal business income and the second one is the speculative business income. Now, what's a speculative business? A speculative business is a business in which a person enters into contracts which are settled without taking the actual delivery of commodities. This commodity can be anything, including shares and stocks. Now, although the tax rates in case of these two types of businesses are same, there is one fine difference. The losses incurred in case of normal business can be carried forward for up to 8 years. In case of speculative business, the losses can be carried forward up to 4 years. and thus it becomes important to differentiate between these two types of businesses. Now, the important question is, what type of business is the intraday trading business? The income tax rules are very clear on this subject. The intraday trading business is to be classified as the speculative business, and thus the tax rates that would be applicable would be the normal tax rates, and the losses in case of speculative business, that is the intraday trading business, can be carried forward for up to 4 years. So we understand that the intraday trading business is a business income. Any profits or losses arising out of intraday trading would be treated as a business income, and to be very specific, as a speculative business income. The reason why I am highlighting this is because these type of profits or losses are to be shown separately in the income tax return. Yes, this has to be shown specifically as a speculative business income or loss in the income tax return. So this was intraday trading. Now let's move on to the next segment, that is futures and options. Futures and options trading. Futures and options refers to contracts or derivative contracts that are entered into by a person to speculate on the quick price movement without becoming the actual owner of such equity shares. As per the income tax rules, all futures and options transactions with respect to equity shares would be treated as a business income. Yes, you heard that right. This again has to be treated as a business income. Now, since it's a business income, it should either be called a normal business income or a speculative business income. Here again, the income tax rules are very clear about the subject. Any profits or losses earned from futures and options in equity shares will always be treated as a normal business income, and the tax rates that would be applicable would be the normal tax slab rates. The losses here would be allowed to be carried forward for up to 8 years. So viewers, these were the different forms in which equity shares are traded on the recognized stock exchanges and their taxability. Also, we have prepared a small chart for you all so that you can refer to it in the future. Please remember to take a screenshot of that. So viewers, please remember, it's not just about tax compliance. Rather, it's about an even bigger picture, which is smarter financial planning or smarter financial decision making. Now, in case you couldn't follow, do remember to give us a feedback in the comment section or mail us at talklevies@gmail.com. Thanks for stopping by and keep watching for more videos.